Hello everybody and welcome to the first in our Rising Up webinar series. Good morning to you if you're in Europe, good afternoon to you if you're in Asia. We have speakers in both continents today. This is the first in a series of 4 webinars across 4 days looking at the extended stay, service department and business travel sectors in the Asia Pacific region. And today we are going to be looking at investor sentiment. So if you aren't one of our panelists, then if you could please keep yourself muted, that would be fantastic. We're going to have around a 45-minute panel discussion, and then we'll get round to some Q&A. So if you have any questions for our panelists, please use the chat or the Q&A function, and we will try and get round to answering as many of those as we can towards the end of the session. The session is being recorded, and if you have registered for it, then you will receive a recording via email in the next couple of days. We are going to put some polls in the chat as well. So, and we're quite interested to get your views as attendees about how travel is freeing up. So there are going to be some questions in the chat. So if you can take a minute or two to answer those during the session, that would be fantastic. I'm just going to show you a few screen grabs from one of our websites, Service Department News, just to give you a flavour of the kind of investment activity that's been going on in the region over the last year, despite the pandemic. So we've seen single asset property transactions, we've seen company acquisitions, we've seen quite a lot of funding rounds, particularly in the co-living space, and we've even seen asset management companies changing hands. So a couple more here. Some big projects in the pipeline, some large mixed-use projects, more funding rounds. Oakwood has teamed up with a Chinese conglomerate to launch a new brand. And despite the pandemic, Ascott, who are represented on the panel today, have had a record year in terms of signing new units and pipeline. So my name's George Sell. I'm Editor-in-Chief here at International Hospitality Media. We are a B2B publisher for the hospitality industry, and we're also an event organizer. And I've got a fantastic panel with me today, and I'm going to ask them all to introduce themselves and let us know what they do. Starting with Vivi from AltoVita, who are also kindly sponsoring this series this week. So Vivi, over to you.
Well, thank you so much, George. I'm really happy to be here, and I'm very excited to learn from all of you today. My name is Vivi Cahyadi Himmel. I'm the CEO and co-founder of AltoVita. At AltoVita, I lead the R&D, the product development, as well as the overall strategy of the company. AltoVita is an enterprise software provider for the global corporate housing sector. And we essentially provide a cloud-based bridge between the very fragmented property distribution system market with global 2,000 multinational enterprises for extended stay requirements such as relocation, client engagement, as well as project assignments. Thank you.
Thanks, Vivi. Hoe Kit, over to you. Welcome.
Thank you, George. This is Hoe Kit. I'm from Ascott, or our lodging business at CapitaLand. So I look after the investment and business development function. Short introduction, CapitaLand, we are a service apartment company traditionally with a history of over 35 years. So as you have seen, which George shared earlier on, we are quite fortunate that despite a pandemic year, we are still able to sign a record number of our contracts with our new partners, our owners. And I think that is a testimony to how resilient the service apartment business model is, co-living compared to hotels, right? So, which is why across our portfolio, even despite COVID, we are still seeing a much stronger RevPAR compared to our peers. Yeah. And today we are moving into other similar long stay, long tenured lodging business like student accommodation and rental apartments, which we have this in our portfolio in Japan, in America, and we are looking to buy more as well. Thank you.
Thanks, Hoe Kit. Blake, welcome to you.
Thanks, George, and welcome everybody. ACRE is a traditional private equity firm that we founded about 8 years ago, and it focuses specifically in the multifamily business. So traditionally, our business has been primarily long stay and very much in the US focused, although we actually started it in Singapore and run the fund management business out of Singapore. But it's been a traditional multifamily business in the US. We manage about $2.2 billion in the space, and I've done it through a series of funds. We've now expanded into Asia, where we're kind of combining a little bit of co-living with multifamily and trying to create a little bit of a hybrid product in that space. And we have a very kind of asset-heavy strategy where we're owner-operators in the properties. So we're not doing third-party management or anything like that. We own the management company, we own the construction companies, and we do everything internally. And we're looking at rolling out a new brand, which we've created called HOMA, which would be for Asia initially, and then looking at where we can brand it in some of our more kind of, co-living 2.0, I'll call it, where it's more private, but with really good drive of community. We can use that in the US market as well.
Thanks, Blake. And finally, Charles, welcome to you.
Thank you, George, and really a pleasure to be with this distinguished panel. IC Partners is a US-owned, Bangkok-based real estate finance advisory firm, and also does take positions in certain properties. But I think where we've been most effective is in Vietnam, Cambodia, and Thailand, working with several family offices, 3 here in Thailand and 2 from Europe, and then a couple of listed traditionally residential property companies that have matured into, I guess, what we call hotel managed residences or branded residences. This seems to have been a real point of difference, not only here in Thailand, but in Vietnam. I guess what I would characterize, our number one attribute would be, really de-risking projects vis-a-vis the capital structure, but also other incentives that can come about from the local authorities, whether that's, for example, the Thailand Board of Investment, where you can have clean foreign ownership, or just how offshore structures or lease structures are used, all about de-risking the capital. So feel lucky that still living in Thailand, although there are some challenges at the moment, but I think those will clear up in the second half of this year. Thanks, George.
Thank you, Charles. You'll be able to see the LinkedIn profiles for all of our panelists in the chat. So if you'd like to carry on the conversation with them after the session, then please do. So, okay, let's get cracking, and let's start with a fairly broad question. So I want to ask you if you've seen an increased investor appetite for extended stay properties during the pandemic, and if so, why? And Charles, maybe you'd like to kick off with that one.
Well, we have, and maybe it's not for all the right reasons, but I'll just start with the obvious one. The alternative state quarantine hotels and service departments that have, I think there are now over 140 of them across Thailand, predominantly all in the greater Bangkok area. So long-term stay would be obviously, not months on end, but for several weeks, or at least a couple of weeks, we've with the mandatory quarantine. So I think this has been really a key source of revenue since really last April, May, when that discipline came in place. But when we look at the traditional, I guess, service department or extended stay accommodation, speaking, I guess, to Thailand or even Bangkok specifically, but even you could extend this into Greater Hanoi and to Saigon with the industrial corridors. And let's maybe focus on the Eastern Economic Corridor. this is really becoming an engine for extended stay, service department, lifestyle type of options, whether a corporate owns it or whether it's just a straight lease. I think we have seen an uptick on that, although the Japanese, have fallen off just because of the cycle of, maturing investments and the COVID. But I really think this will be the engine going forward, is in these industrial corridors in the 3 cities I just mentioned, but particularly in the EEC. I think you'll see a lot of growth.
Thanks, Charles. Hoe Kit, Ascott has a large and growing portfolio across the region. Are you seeing increased interest in the service department model from owners and investors as a result of how those properties have performed in the last year?
Actually, yes. So we shared our signing earlier this year. We had another record year of signing last year. So what we have gone through with our existing portfolio is quite clear to our current owners as well as to prospective owners, which they certainly see the resiliency in the business model. In fact, and interestingly enough, and some of these people would have come to us, to look at possible conversion of their existing buildings. Some of them may be an office building, some of them, may be a hotel, and of course, each building are quite different, and both have their own limitations depending on the floor plates and so on. So some are possible and some are not possible.
Okay, thanks, Hoe Kit. How have owners and operators managed to, how have they had to adapt their strategies to manage assets during the crisis? Blake, would you like to kick off with that one?
I can try. I mean, we are an owner operator, so we kind of we manage our own properties in all instances. So, to how they've been able to manage, I think if you look at the long stay multifamily market, although it's really outside of Japan, doesn't really exist in Asia, they've been able to manage it incredibly well. I mean, if you look at Hoe Kit's portfolio from Capital Land, which actually when I was at our Capita, we jointly owned together, it's done incredibly well. I mean, our portfolio in the US is about 95% occupied. I think people value the importance of home even more as you get stuck in home. So, multifamily really has performed, alongside logistics in terms of performance, really as kind of the darling child out of COVID. So, I would think that, in the long stay multifamily, and we're talking about more traditional multifamily, not, at the high end kind of service residences, but more in the traditional rental housing or build to rent, as you guys like to call it in the UK, it's performed incredibly well. I mean, managers are actually scrambling to find staff to, there's no stress in the market. The stress is, how do I expand faster? Which is quite a bit different than the high-end, high-touch, managed properties that are catering to a much shorter term. I think the trend towards longer-term stay is happening outside of Japan as well. I think this is a societal change where people are starting to feel comfortable about renting, particularly the younger crowd. You can only take so much abuse from your parents for throwing money away in rent, but these kids are actually just saying it's okay because, I might want to move in 2 years and I don't want to get stuck buying this place and being stuck here. So I think mobility and kind of like, they may have gone to school overseas. So when you look at maybe, the Thai market, for example, or the Chinese market, you're actually seeing for the first time, hey, I rented a place when I was at university. It's actually pretty good because there's a huge sense of community, which I think also maybe over the past year or two has really driven a lot of people together, where in a traditional condo rental market, you can't have that sense of community. And I think it's probably, like with Ascott and Hoe Kit's portfolio, that's really what kind of drives people to go to that type of product, or, in our case, our stuff, because people get a feeling of it's more than just renting a box in the sky. It's actually, there's activities, there's community, there's things to do. So I think that that engagement is probably what's challenged some traditional developers who don't quite understand that kind of tenant engagement or that kind of community building, which is really important. So that might be a challenge for some to adapt to, but generally overall, the long-stay multifamily market has been very, very strong.
Thanks, Blake. Charles, the assets that you've been involved with, how have you had to change strategies, if at all, to cope with the landscape in the last year or so?
Yeah, I think I'll pick up on the theme that Blake was just speaking to, and that's the sense of community, the engagement, almost inclusionary. I think over the last 4 or 5 years here in Bangkok and also down in the Eastern Economic Corridor, I think developers have found themselves working much harder on what would, I guess, be common areas, but even some commercial areas that would be carved out with separate strata title, and then really working on that over and above, what kind of bath shower you have, or toilet, or whether you're floor to ceiling heights or any other wireless. I think this has probably been something that is a big standout, where we didn't see that even 5 years ago, and it's become a key attribute in the sales. And then picking up on what I mentioned in my opening comments is, to the extent that a developer chooses to incorporate a hotel or a serviced apartment accommodation that would require requisite licensing and the operating attributes of hospitality, then this adds further to the texture. But I think Blake really hit on the theme that's going to not only carry out from the US and maybe the European markets, but increasingly here in Asia Pacific, on the sense of community. Even if you only have a few hundred square meters, it's just how you listen to your customers and then work your designers to actually get a great product.
Thanks, Charles. Vivi, this is probably a good time to bring you in to talk about the demand, where the demand is coming from, and what corporate clients are looking for from a development, because I think that's going to overlap with quite a bit of what we've just heard.
Yeah, absolutely. I mean, exactly what Charles said, listen to the customer is what we did just over the past few months. In fact, we're currently launching together with our brother partner, Benevo, is a relocation technology company, a white paper. Within that is some interviews of HR mobility specialists. And when, from the interviews, it was fairly clear that during the pandemic, volumes went down. Only business critical move actually went ahead, even though they were delayed. And discretionary moves like cultural training, development for future leaders were probably still pending. But now that appetite has changed entirely, everyone's pretty much getting ready for business as usual. One key metric here to think about for all of us here, before the pandemic, traditionally there's always maybe 1 or 2% of the employees' workforce as mobile employees. To think of multinational company who has hundreds of thousands of employees, they probably have about 1 or 2,000 expats and mobile employees at any one time. That landscape has now changed entirely because with work from anywhere trend, virtual assignments, that really unlocks the opportunity, which means there may be about 20 to 30% workforce who could be mobile. So what does that mean really for our sector? That means maybe a rise in flexible rentals, extended stay is here to stay, but flexibility is extremely key. We did an innovation summit. It's a 3-month event that is currently ongoing right now. During the design thinking session, we had 400 participants, and we did a survey there. Staggering number of 93% preferred flexible leases, so weekly and monthly, and only 2% actually chose the fixed 2-year term, which is super, super interesting. And of that, there are four key trends that came out of it. One, pet-friendly homes are trendy, so we are seeing double pet relocation. So gentlemen, please do incorporate our little friends when designing your apartments, your units. And then also family friendly is super key as well, which means that there has been less and less demand for studio and one bedroom. Just studio or hotel room rather. You need a bigger unit, and really turning around how those one bedroom or studio units into multi-units is in our opinion is fairly key. We're always looking for bigger units. It's very hard to serve our clients who are staying for extended stays with just one studio. A third one that came about is work from home amenities. So we need to really give them beyond what they can have in the room. So what Blake said about sense of community really resonated with us as well. So a lot of HR professionals are looking for solutions to allow their employees while they're being relocated as access to be able to work from home effectively, that's for sure, but also be able to communicate with their community for the first 30 to 90 days that they stay in that temp housing. The last one that we're seeing is safety security. I mean, a lot of you here manage properties, so you probably have 24/7 reception, so on and so forth. But when it comes to multifamily units or independent units, then that's when the issues come into play. So there has been an increase in demand for fire extinguisher, TV, self-check-in, safe, so on and so forth, so that these unique homes can also have the same level of safety and security as the managed buildings.
Thanks, Vivi. I think flexibility is an interesting point here. Blake, on the multifamily side of things, is this a trend that you're seeing, that people want more flexibility in terms of their leases? They want rolling leases, 1 month, 2 months, rather than signing up for 6 months or a year?
Yeah, absolutely. And I think that's, in our Asia strategy, we're actually accommodating that down as part of the key business plan, really is to allow for flexible leases. We would estimate that probably 60% of our portfolio would be annual leases, with the other 40% being, multi-month or even multi-week leases. We're not really in the hotel business and kind of into doing daily stay, but we're actually licensed under Board of Investment as long stay hotels. So we can go down to a day if we wanted to. But yeah, definitely flexibility. In the US, we're seeing also flexibility and some use of technology. I mean, the US has always been very rigid in that it's always annual leases and you always pay your rent 1 month in advance, and that's just the way it is. It's not, quite as extreme as a market like Jakarta, where you pay your rent 3 years in advance and then you don't know who your landlord is anymore after that next day. But there's definitely an advance payment program. Through the use of technology, we're now able to change people's payment scheme, more like the UK, where it's almost like a weekly payment scheme. But it was always too inefficient to be collecting rent every single week. But particularly in the affordable segment, it makes a big difference for people that they can plan their payments out on a weekly basis, as opposed to having all of a sudden this big hit at the end of the month. So I think that not just having the length of term locked in terms of being like a fixed term and being kind of rigid, I think having payments to be relatively flexible is quite important as well. And we're able to incorporate that with a partnership with a group called Till, which is a tech provider that we use in the US.
Does this make your forecasting and revenue management more problematic, offering all this flexibility?
Yeah, I mean, there's a few more lines on the Excel spreadsheet that, my colleagues get to play around with, but it's, I think it's not that much more difficult. We're offering a limited service option in Asia, and it's more of an affordable option. So it's generally, even the long-term leases though, do have like a weekly housekeeping component, just so we can maintain the buildings a little bit better and have access to all the rooms. So it's not that much different doing it and having that housekeeping provision once a week versus renting to somebody once a week. So it's, a little bit more turnover, but it's not that bad.
Yeah, okay, thanks, Blake. Let's talk about M&A activity for a bit. Hoe Kit, over the last few years, Ascott's made some really interesting acquisitions. You've had Quest, the Tausia hotel chain, Synergy, so all complementary, but all quite different. Is your strategy going forward to mix organic growth with acquisitions, and would you consider going into other new asset classes too?
I mean, short answer is yes. So, I mean, while they are quite different from what you said, but it is also fairly similar. I mean, to us, it is about an ecosystem. So all the things that Blake, Charles, Vivi spoke about in terms of engagement, in terms of community, in terms of doing things that meet the guest needs, and it's all about creating an ecosystem that fits, right? So you know, for Quest, it is actually a service apartment model, which is biggest in Australia and New Zealand, and you know that has been doing very well and growing. Service apartment, so very resilient, and we are taking that, you know, to grow in elsewhere. It's a franchise model where we give the option, you know, to somebody who's interested in the business. You take the brand franchise, you know, and we guide you, train you to how you want to run it as your own business. In the other parts of the business, it is more of a management business. So we manage for our own capital who is buying, and as well as manage for third-party owners. Almost 80% of our portfolio are actually managing for third-party, and that is still growing very well in a very difficult environment. So we'll continue to look out for more of this M&A, you know, to complement the organic growth, whether it is PropCo, OpCo assets or portfolio. And so this is an ongoing activity. You know, the teams on the ground, you know, look out for more of such business to manage for third-party owners, you know, to put up a franchise, or, you know, to even look at investment opportunities, whether at a platform or at a portfolio, at a single asset. Yeah. And the other things that we are doing during this year, you know, we started our foray into the student accommodation business. Some say, you know, a bit late, but, you know, better late than never. I think we see tremendous promise, I think, in this sector. And, you know, we have chosen the geography very well. You know, I think, you know, such that when borders are remain closed and international students are not traveling, you know, we have identified, you know, certain universities, locations and states, you know, where we want to be in, where we can tap on these demand for these universities, you know, where there is a fair bit of domestic students. I think that will continue to drive that business, and it's very synergistic, you know, for us in the lodging space, because it's just lodging, you know, but catering to a slightly different age group. As you know, we use our service apartments of different brands and tiers, catering to the senior executive, you know, the middle level executive, whether for shorter stay, longer stay. We have senior service apartments that caters to the active seniors. You know, we have the co-living that caters to the more young at heart, the millennials. And then now this is student accommodation, you know, that caters to the students. Like, to us, it's a very natural progression, leveraging on our track record and expertise. Yeah.
Thanks, Hoe Kit. Charles, I think you mentioned that you have recently sold one of your brand portfolios. Do you see a wave of M&A acquisition around the corner in the region for extended stay type properties?
I do, and I think that gets back to, I think, with the comment that Blake had made about HOMA, you know, as they leverage that brand, particularly in the extended stay or long-term stay residential market, whether you're trying to be add those extra value-added services that a brand really you can build on. So Envision Hospitality did sell its Glow brand and several other brands and management agreements to Lodgis last month, or actually the end of March. And within that portfolio, of course, there's hospitality, but there's service department branding offers as well, or at the mid-scale or upper mid-scale. And I think this then provides an opportunity to grow, in the case of that acquired, in the Indochina footprint. So that would be, Vietnam, Cambodia, and of course Thailand. Myanmar is a bit off right now and will be for some time. So I think there are a number of brands out there that probably might, and operators that might feel a bit vulnerable just because the pain and suffering that's been happening for the last 15 months. So I would expect some additional acquisitions to come up. And I would believe that some of those will be service departments or extended stay offerings. And I think the multiples you can still rely on, or at least hold out your the numbers from 2019 as a starting point.
Yeah. Okay. Let's talk specifically about co-living, which I think is an interesting sector, and it is gaining traction with corporate travelers, with professionals, and so on. Hoe Kit, could you start by talking a bit about the Life brand and your plans for rolling out that, and who is actually staying at the Life properties? Has it surprised you, the guest demographic there?
No, I think we had designed that, I think, right from the very start, to have a space where it is small enough that, it fits the requirements of the people where you want privacy. Yet, we give them enough social space, collaboration space where they could still interact. I think as a result of that, we saw that even during last year, in our properties, in our Life in Funan, the occupancy remains above 80% throughout the pandemic, because there is actually people that is not worried about moving into a place like this to stay, because you still have your own safety and privacy, unlike some of the other properties that we saw. So we started this by a group of people in a company, and the tagline was actually for millennials, but designed by millennials, right? So, and it has turned out to be very well received. The first property is what you have in Singapore, and we have got several more properties on the way. I think even last year we were still able to sign up the 1,000 units of co-living from different countries. And there are 15 more coming up on stream. I think we hope to open another 5 or 6 this year, right? So this model, I think, has now been pretty well received in Asia. We are wanting to take this to Europe and looking at similar opportunities, whether it's in investment or managing for third-party owners.
Mm-hmm. Thank you. Blake, what are the challenges of combining co-living and traditional multifamily in the same development, and why have you chosen to do that?
Yeah, I mean, from our research that we've done, I mean, we don't have a property that's open yet. Our first property will open in Phuket on October 1st. But based on a lot of time spent over the past few years speaking with focus groups and end-use customers, I think people felt that in Asia, it's pretty chaotic wherever everybody is. And in these big cities, it's very noisy, and they want the ability to, as Hoe Kit said, go back to a private space at the, and be able to close the door and have your own kind of privacy. But at the same time, community when you want it. So that's, I think, how we kind of designed our product a little bit different, where all of our apartments are self-contained. So all of them have their own shower and their own kitchen inside. So they're relatively small units, maybe 30 to 35 square meters, but with really, really expansive common area spaces. So we tried to take, instead of having kind of bigger apartments where you might just stay there more often and stay inside, you almost make them small enough that you almost force people to go outside. But not so small that if they really want a day off, they can close the door and watch Netflix and be at home. I think the other thing that we incorporate, besides that, a big feedback that came back, was really health and wellness. And this came across all income levels. That you know, everybody wants to be healthy and well, and this doesn't kind of most mentally and physically. So we spend a fair amount of effort around that. You know, you don't create a gym that's in an apartment that you couldn't rent and you just stuck a couple treadmills in there and called it a gym. I mean, you actually plan it out properly, and you put in, you know, yoga and gym equipment and swimming and other things that this demographic that we're focused, which really is the kind of the 25 to 35-year-old crowd, really cares about. And then the other thing that we've incorporated as well, which you typically don't see in traditional multifamily, is co-working spaces. So in the lobby of the buildings, we build meaningful size co-working space that is really for the residents to use. So they can get out of their apartment, go down, plug in, and they're kind of in a semi-office type environment. Still casual, but better than, you know, having to walk to Starbucks every day just to get out of the house. So by, again, you know, you kind of keep people within the ecosystem. You force a little bit of interaction amongst everybody. And I think also technology can help in this area where, because, you know, like Hoe Kit has in their residence app, and we've also got in ours, and, you know, it's not unique just to us or to Capital Land, but you can really learn a lot about your tenants and also drive sub-communities within there. I mean, if you think about a fairly transient population who are 25, just finishing university, and maybe they just came back from London or the US, and maybe they don't have that many friends, and they've been assigned to go, you know, be the accounting manager or the F&B manager at a hotel somewhere. And, you know, you can really learn a lot about what people like, what they don't like, and then you can create sub-communities within the bigger community. So you can create a football club. You know, you can create a yoga club for people to do things in, and then all of a sudden you're creating more interaction. But again, giving people that private space that you're not really forcing everybody to kind of wake up in the morning and see somebody's dirty dishes in the common sink. That, I think, to me is maybe the evolution of what we've tried to create, if that answers for you.
Yeah, that's great. Thanks, Blake. Vivi, in terms of demand, are you seeing more requests for co-living type properties from your corporate travelers?
Yeah, absolutely. I don't think I mentioned earlier before, but from the survey, we understand that 64% of the companies we interviewed, which really were very diverse in APAC. So just to give you some background who we actually spoke to. So HR mobility from in Korea, in Japan, Australia, Shanghai, Hong Kong, and Singapore, and India actually, representing commodity powerhouses, car manufacturers, government agencies, events, and then other engineering software manufacturers. So with that, actually, that means they also don't require just the metropolitan cities type of accommodation, but also remote locations. I would be curious to ask the three of you, what are your strategy or proposed solution in order to cater towards those demand looking for remote locations and beyond, you know, Singapore, Hong Kong, Shanghai, Tokyo, but really in the remote locations. That would be a good thing to understand. And then also the other thing I would like ask the three of you is, what is your strategy for creating more flexible, not just lease terms, but flexible configuration of assets? So how can you potentially convert hotel room or apart hotel room or studio into more multi-family, multi-unit apartments?
Okay, who wants to pick up on that one then? The gauntlet has been thrown down.
I could take a shot at the first one, Vivi, around, I mean, kind of the strategy. It sounds like what you're really looking at is, what's our strategy towards moving to where the jobs really are, or where the people are really having to work? Yeah. And not everybody gets, you know, to work on Nanjing Lu in Shanghai, as you said, right? Like a lot of guys are stuck at some factory out in Wuxi and like miserable because there's no place nice to stay. So, I mean, going back to what Charlie had mentioned as well, I mean, if we look at the Thailand context, we're also very focused around where that Eastern Economic Corridor is really building out and the level of kind of jobs and everything else that are being created in, regular everyday industries, as you mentioned, like car manufacturing, or, the infrastructure and the engineers who are working at the new airport and people like that. We just acquired a new asset in a market that Hoe Kit has a couple properties as well, but it's very much an industrial town outside of Bangkok called Sriracha. And it's where all the Japanese community are. It's literally like we might as well be in Chiba Prefecture, but it's 100% Japanese town outside Bangkok. And it's where all of the manufacturing and everything is going on. I mean, so I think it's absolutely the right strategy. I mean, everybody wants to kind of have flagship properties in the gateway cities, but sometimes, and if you look at it economic wise, you make a lot more money in the second tier cities as the owners, because your land cost is much lower. So your yield on capital and the yielded cost really is actually better. And I think it's actually more stable. If we look at what happened in Thailand, generally, even service apartments in Bangkok, although they didn't suffer as bad as hotels, still suffered. But if you look at in a market like Sriracha, which is almost 100% long-term business, I mean, Hoe Kit's got, you've got Citadene's property there, you've got a Somerset there. The occupancy didn't even drop, right? It's completely stable because those jobs are very stable and not really tourism related. So I think that, we're certainly following that strategy. The other biggest challenge, I think, in Asia, and I've heard you mention this a couple of times, is kind of the idea of conversion. And, how do you look at not building everything from the ground up? I mean, takes a long time, but again, there's not really multifamily in our US portfolio, or in Japan, you can go and buy a multifamily building tomorrow. I mean, you might have to pay up for it, but you can find them and you can do some value add rehab. Unfortunately, in the rest of Asia, you can't really find that. So you're either stuck building from the ground up, like we generally do, or trying to squeeze a hotel property, perhaps that's closed. As Charlie mentioned, 80% of all the hotels are closed or closing right now. And that's going to create a lot of kind of stress, obviously, to the owners. Can you take some of those and combine them? I mean, we don't see a huge demand, though, from very large units in the rental space, not in Asia, at least. I mean, we see it more that actually it's more towards this, singles, small rooms, maybe 1-2 bedrooms, but kind of building 3-4 bedroom rental apartments like that look kind of like the backdrop behind Hoe Kit's screen. That's pretty rare. I mean, that's like a nice Ascott apartment, but that's also like, $8,000 a month. So I think that our view, and at least the market that we're carving out, is more on the affordable side. So we're looking actually at smaller stuff, not bigger, where you can take maybe some of these older hotels and, maybe you're combining 2 rooms into one, but it's not really that much more. The biggest issue that we find are things like ceiling heights and stuff. You kind of get stuck, right? And, you don't want to be reaching up and touching the ceiling. And in those older buildings, that's the biggest challenge. Even if you strip it right down to the concrete shell, I think that's still something very difficult, because in affordable housing and small spaces, high ceilings actually make things look pretty okay. But if you got a small space and a 2.5 meter ceiling, it's like you're living in a cave. So that's the challenge, I think.
I just wanted to I agree with what you're saying on the design points on any repurposing of a building, and there will be some hotels that should frankly just not reopen over the next 3 to 4 years. So that will be a challenge. But I couldn't, when Vivi was talking and flipped it over to you, Blake, when you were talking about co-living and sort of the whole ecosystem, the other part that, just to add incrementally, is I think the precinct of where your property is and having leadership in that precinct. It could start off with just 1 or 2 blocks, but maybe this doesn't work in Tokyo, but definitely if you're going to go off the market a little bit, like Sriracha you mentioned, but even little micro precincts, there are probably a dozen of those here in Bangkok. There's several in Pattaya, there's several in Saigon, in Hanoi, where it's a combination of the residences, it's the hotel, it's the food and beverage, it's the bake shop, it's the cleaners. these precincts where you have some like-mindedness, but it does take some coordination to tell that story. It's like a storybook. This will also help raise the values, the gentrification, all these phrases that you've heard in recent years. I really think that this will be another factor that developers or investors should look at as to what, it's just not about the building and how you've maybe repurposed or you're programming 300 or 400 square meters so that it's a great gym. It's also when they get out on the street, is it the same old Starbucks or is it something else? So that is a very magical part of it, I think, that can really unlock value. But it does take a lot of leadership and coordination.
Thanks, Charles. Blake, I just want to come back to you quickly and ask why you decided to go down the OpCo and PropCo under the same ownership route, and what are the pros and cons of that?
Well, I'm not as big as Hoe Kit that have the opportunity to kind of have this brand that everybody knows that I can convince another owner to let us manage their building, maybe one thing. I think in our US operations, we learned that we were constantly being disappointed, I guess, by having, honestly, service providers and brand or other external management companies who maybe didn't see the same vision as us and trying to create this sense of community, particularly in the affordable housing sector, which generally people just think that just means, a roof over somebody's head and a door that locks. And we really wanted to try to create something a little bit different. And we found, honestly, that we couldn't really get that consistent level of third-party management. So that's why we went down that road. I mean, we're a traditional property company to start with. So do I want to be in the property management business? Probably not, if we didn't have to. I mean, unless you get massive scale like Ascott and Capital Land have, it's actually not really that great of a business until you can really break into the big leagues. But we did it just to deliver better quality execution. So that's why we've taken what kind of lessons learned from our US, and that's what we're applying it into Asia. Maybe at one point we get big enough where we can be a little bit more asset light, where people recognize the value of the brand and that the network and everything that we built up, but we're also, kind of new kids on the block. So we don't really have that luxury yet. So I think that's probably why we have to go down that road.
Thanks, Blake. Real estate investment trusts are a popular investment vehicle in the region, but also in the States, but perhaps not so well known here in Europe. Hoe Kit, you've got a lot of experience of these. What are the advantages of the setup there, the real estate investment trusts?
Actually, it's a very straightforward because it offers a stabilized income to people that would invest in this real estate investment trust. So of course, you have different types of REITs in short, because you have REITs for the offices, the retail, the industrial. In our case, our Ascott Residence Trust is basically a lodging REIT. So they own stabilized properties that were either previously owned by sponsors, and they have been growing and injecting into them. Of course, they could also go out there to look for other similar stabilized properties to buy. And the beauty of it is it's actually a very good and income yield story, and it's a very good investment, for anyone who will be looking at this, that offers any time around average 5-6% of yield, which is rare to come by, right? So that is the good part. And on the Capital Land part, between the sponsor and the REIT, I think it's a very good combination that the sponsor can continue to support the REIT and inject stabilized assets into it. And for us, we also have different value add development funds that we continue to buy on behalf of our other investors who will put money with us, and then for us to deploy this capital all around the world, whether these are in the different assets that we currently have, right? So we have our service residence private fund, that does that. We are looking at student accommodation, bringing capital investors to do that. And our REIT, has gone on, to buy core student accommodation asset. And I think then what we are really looking at from the sponsor is to continue to support that, to have more of such assets, whether at the development, at greenfield, that today we will incubate and subsequently inject into the REIT.
Thanks, Hoe Kit. In the investment real estate world here in Europe, we're hearing a lot about ESG investing and the importance of sustainability, social responsibility, and so on. Is that also prevalent in Asia, and how is that affecting investment decisions about real estate over there? Charles, would you like to kick off with that one?
I've seen a number of investment prospectus from capital raisers that are trying to seize the opportunity that probably exists for at least another 18 months, maybe 24, not only in Thailand, but in the region. In all of their disclosure documents, marketing documents, there's an ESG section that speaks to the holistic view about helping the Thai economy, the Cambodian, whatever, Vietnam economy, Philippines, and that the capital that would be deployed, the acquisition that would be undertaken, is subject to and I guess a standard that's been set by the GP, the general partner, in so much as it's almost a CSR component, and that they will adhere to. I think the World Bank and IFC, they've set some standards like their EDGE program, which is basically like LEED for dummies. I mean, it's just the lowest bar just to get it, a LEED certification or an EDGE awareness. I feel like this will become a critical factor for, I guess, raising capital through limited partners, provided the general partner actually, sticks to that, whatever their ESG code of ethics were, and then following through with that all the way through the life cycle of the asset. But Blake would probably have a better view because he's living and breathing it more.
Maybe I could just add to what Charlie was saying. As a kind of small fund manager to ourselves, we're very, very focused around this. I think, to your point, it's much stronger in Europe and the US in terms of the prevalence, and it's built into the building code in many cases. When you look at emerging market Asia, so for example, Singapore, it's in the DNA of the building codes already that every building basically has to be greener than most countries would ever get to. But in emerging markets, I mean, we look at it as not only is the right thing to do, but when you look at it from a long-term ownership perspective, it's profitable to do. When you consider double glazing all the windows in the building, people think, well, gee, you're throwing away $1 million. But if I can save $150,000 of electricity a year because I did that, that's worth $2 million, right, or more in a 5 cap rate environment. So we kind of look at things both financially and others. But like our buildings in Singapore, in Thailand, will be the first LEED certified residential rental buildings in the country. They're also EDGE certified as well, and they'll be the first EDGE advanced buildings in the country. So we think of it as not something we hoped we should have done when maybe it becomes more mainstream in Asia, and then we go and roll up a large portfolio, and somebody like GIC or Quadreal or one of the big pension funds says, "Gee, it's really great you have this, but you're not certified. I can't buy it." So I think you really do limit your end buyer universe as well when you move from kind of the private equity funds into more of a core fund, and you're selling it to Prudential or M&G or these others that say, I can't buy it unless it's certified. That doesn't exist in Asia today, but it certainly exists in the US, Canada, and Europe. So why won't it exist in Asia? It absolutely will, and it will soon. So I guess we're kind of future-proofing our exit universe, but also I think it makes a difference to our tenant base, who are maybe a little bit more socially and environmentally aware in ESG. I mean, we got to remember that ESG isn't just about saving electricity bills, right? It's about also that social aspect of things. Of course, the governance and everything else is hand in hand with kind of any reasonable fund management platform. But I think you have to look at the social side of things as well too. I'm not convinced people will pay more rent for it. They may move to your building because you've got it versus somebody else who doesn't, but I don't think you're going to see additional rent paid by tenants, particularly at a level where, you're kind of a price point driven market in the affordable space. But I think they will choose you over somebody else if you can educate them that, hey, it's just better and it's certified and they might feel good about themselves. But I do think you will get better pricing from the institutional exit by having it in place. But to Charlie's point, again, you need to have, and we have like an ESG officer like on our team, and all he does is just make sure that everything's compliant and it's always compliant, and that, Prashant at IFC gets his reports all the time about the, that it's being monitored on a monthly basis and that everything is being compliant, or whether it's the Green Building Council or whoever else. So, I'm sure this is a huge operation within Hoe Kit's group, much bigger than ours. But I think, whether you're big or small, I don't think you could ignore it. I think you're crazy not to. And I think that a lot of the for sale developers, which we're talking about residentially, if you're in a for sale environment, I honestly don't think you care. I think you're selling it to somebody else and it's a condo product, and that's, it's going out the door. I mean, we got to remember real estate and construction is something like 40% of, is it 40? It's a huge number of all carbon that's emitted in the world is due to our inefficient construction methodology of using concrete and steel and everything else. So I think it's certainly the right thing to do. I don't think you'll see some of the huge mass market for sale developers adopt it though.
Yeah.
I think that would be too kind of, blue sky and sunshine kind of approach to things.
Sure. Thank you, Blake. Hoe Kit, did you want to come in on that one?
Yeah, I mean, I want to echo what Charles said about opportunity and what Blake said about profitability. So all these are true, but it is also a responsibility. So, I mean, while it is fairly new in this part of the world, I think it's growing in importance. I think it's also very critical that we recognize this. So, I mean, as a group, then we have actually put in place a 2030, sustainability master plan with, targets of what we need to achieve, whether in terms of carbon emissions, in terms of water, waste, energy, and so on, right? So that is something that actually we have made it important and critical that we incorporate into our investment strategy. So, for the group, when we look at an investment, we need to incorporate the sustainability targets into what we look at, whether it is an building that we buy or it is a development that we build, and then put in place a plan, to how to achieve, and which is in line with the group sustainability target. So this can be everything, from the design, to what you put inside there. Blake talk about the example of a double glazed glass, and there's a lot more you can do, and that goes into day-to-day business practices and operations, and what we can do to actually make every of these effort count.
Mm-hmm. Thanks, Hoe Kit. Just quickly, because we have reached the end of our hour. This has flown by, this session, because it's been really interesting. But Vivi, from a demand side, are you seeing your corporate travelers, especially from blue chip companies, are they demanding to see some sort of CSR policies from accommodation providers?
Yeah, precisely. That's exactly what I wanted to say. Yeah, we've been seeing a lot of it has been client directed. And I think the challenge right now is to really how to demonstrate the accountability, how the audit flows actually goes. And there hasn't been an easy way to do that. It's so much to say within your marketing material, but how comfortable are you as the asset operators and managers to be able to thoughtfully and structurally demonstrate the accountability in delivering the responsibility, as Hoe Kit said?
Great, thanks Vivi. So just before we wrap up, I just wanted to share the results of the poll questions, which make for quite encouraging reading, I'm glad to say. Question 1 was, are you personally feeling a pent-up need for travel coming out of the pandemic? And a whopping 96% of people said yes. Question 2, are you planning to travel within your home country this year? 82% said yes. And question 3, are you planning to travel internationally this year? And a surprising 75% said yes. So that's good news for all of us going forward. So thanks very much to everybody for joining the panel today. I think it was a fantastic discussion. Tomorrow's session is talking about the apartment of the future, where we'll get a bit more granular about unit design. And as you can see, we have another great panel there. The link to sign up for that one is in the chat. A quick reminder that the Service Department Awards will be taking place in London on the 24th of June. Last year's awards were pretty much the last big event that the sector had before everything shut down. And this year, I think it's going to be the first one back. So we're really looking forward to seeing loads of you there. And all I have to do now is to say thank you for watching. Thank you to AltoVita for sponsoring. And thanks very much to Hoe Kit, to Charles, to Blake, and to Vivi. Hopefully see you on tomorrow's session. Thank you very much, everyone.
Thank you.
Thank you. Bye.